So let me begin. Yes, let me begin today's video with the official hashtag joyant, the official hashtag jubilant, maybe the official hashtag we're looking for Loch Ness Monster patterns. That's just a joke. You had to watch the last video to get it. And anyway, welcome to another daily video. My name is Doug with Trade with Doug. This is where I'll do my best to take a grope in the murkiness. I'll try to make some sense out of the stock market for you. And hopefully whatever we discuss puts some money in your pocket. Before I take one step further, let me remind you that the Checkmark Trading Strategy course, this is the last few days of the 35% discount. It's going to be over 10 hours long. It includes lifetime access to the day trade room, lifetime access to the part-time trader program, plus live interactive weekly webinars. If you are a trader that is ready to elevate your game, I will share all 2 decades of my trading experience with you. I will post the link here. Check it out if that's something that you're interested. So I will start this session by saying, did we see a trap? Was the trap set for the bulls? Because where we left off yesterday, let me show you what we had. You know what we had. First of all, let's talk about tech earnings. We had some amazing tech earnings. We saw some big moves, Qualcomm, Apple, Facebook. We had great earnings last night, making everyone feel this market is just destined for more greatness than it's already had. You had the Fed chair spitting out just what we need. More QE coming, more money flooding in the market. There's no such thing as inflation. People are so optimistic about Corona. The market rally continues. And we saw this onslaught of market rippage. We saw these tech earnings after hours. Just add to that. You got all gap ups in the indices today, the Dow, the NASDAQ, S&P, but then when the bell rang, the party kind of changed, did it not? You got some pretty aggressive selling, and of course you've also had some very aggressive buying to accompany that. You got yourself a nice little aggressive V-shaped pattern. Now, obviously, this is perfectly normal market activity, right? So is this a trap? This is what we're going to talk about. Is this a trap or not? It's a little too early to say that that's exactly what it is, but here's what you're seeing. You're starting to see some fragile cracks within the market. I've always said this before in many of the talks that I've had, is that the market always leaves a trail of breadcrumbs around before it starts to rear its ugly head in market corrections. There's always something there kind of forecasting what was going to happen. Now, if you go back to last week, we had Joe Biden's tax plan, or the proposal of that tax plan, and capital gains that sort of sent a little message into the market, sold off, but the next day it comes back. We rally all the way up to today, and then here we are 1 week later. Maybe it's just a Thursday thing, which is like, it's called like tanking Thursdays, right? But we'll see how this progresses over the next couple of days. It's starting to feel like we're on a little bit of thin ice, but still, you don't have a signal to just lean into this market short just yet. But it is something to take into consideration. Let's go back and take a look at Apple and a couple of these other names. This is a pretty good pullback in a stock that had some really good earnings. Let me get rid of that trash on top of the screen. I mean, really good earnings. You go up to 139 here after hours. Peels off all the way down to 133. That's pretty big for Apple. I think you have this overstock here the last time I checked, OSTK. Same thing here, a really positive response early on. 88, now you're all the way down here to 74. Now that's a pretty aggressive turnaround on it. Qualcomm here also, it's kind of hanging in there. It's not doing so bad. But this is also something that sometimes happens with earnings. This is why for you newer traders out there, I highly recommend that you avoid trading anything through earnings, because you just never know how it's going to be. Sometimes you get a company that does very well at earnings, but yet the market sells it off. Sometimes they do very bad and they rally. Sometimes they rally first and sell off later, just kind of like the Fed meeting. Sometimes it's very aggressive first and then it becomes very aggressive later as the news gets digested. You always need a few days for these things to settle down after earnings. Same way with IPOs. You need all this emotion and all this stuff to settle down before you can get a really clean snapshot or a predictable snapshot about what's going to happen. But let's go back to the market and talk a little bit more about this. We're starting to reach a couple of areas here that are interesting. And I say interesting because you now have the Dow Jones here, 34,164. So you've got to really start thinking at some point here that 35K, 34 and 30, well, obviously 34, but 35K coming into play here in this market. Now, we talked about it before if this is your first time around. The market loves whole numbers. It's always had an obsession with round numbers. I remember the old days when they used to, maybe they still do, where the Dow 10,000 hat, Dow 15,000, Dow 20,000 hat. So it's always an emotional milestone, and normally you're going to see this across the board with stocks. This helps you guys with edges and stuff like that in your personal trading. But normally what you will see is anytime a stock gets near a whole number, it just plows right through it. So I would think before we see anything, you seem to be too close, but anything can happen. Again, this is marketing. I don't want to say that this is a guarantee because there's no such thing. But you would think that it's going to take a swing at 35K before you see any serious pullback. We said the same thing when the S&P was trading at 33 and 3,400, saying it was going to go to 4. That's what happened, and oftentimes they overshoot that target. And the reason for that is I feel it's one, it's an emotional milestone, and the other is that you're coming back so strongly after. This has to be one of the most epic recoveries I've ever seen since I've been trading, if not the best. I mean, after coronavirus, going from where we were last year in the first, news reports of coronavirus, the first wave of lockdowns, and how there was so much no understanding of that virus and how it was going to work and how it was going to impact us. Many people thought it was just going to go away in a couple of months. I don't think most of us knew really the full extent of this thing 1 year ago. But now we see that this lasted much longer than any of us ever wanted. I mean, some people probably knew about it, but there's a lot that didn't. And there's people on both sides of the fence. But to see how the market sold off from a good 35 to 40% retracement, rallied that back, tacked on another 100%. I mean, these markets are up 100% almost from the lows, is just outstanding. I mean, that is just staggering. And I think we're in this phase where you're constantly seeing, as long as the Fed is not going to taper, it's going to be hard to get sustainable market retracements. I know everything points to being short. I've thought about shorting. I've dreamt about shorting. I've bowed to the trading gods and said, let me please short, but we haven't gotten the signal yet. We haven't gotten a euphoric blow off top. And you know what? Maybe we don't. Maybe that never shows up. So the thing here today is, again, you're going through this same pattern, and this is a pattern that's going to have to stop. I'm going to show, I'm just looking at the Dow right now, and just my eye caught this. Every time you get an aggressive sell-off, it's immediately followed by an aggressive rally that takes out the sell-off. So this bearish thought is it's so temporary, and you can't get sustainability that way. In order to get a correction, you've got to knock down and stay down. You got to keep the pressure down and keep the selling pressure coming. You can't just train investors and traders that every pullback equals a brand new high, because they're just going to keep buying the dip until it stops working. So until that stops working, none of this stopped working. You had inflation concerns and a few other concerns a month or so ago. We were talking about in all the market mutterings, right? The QQQ stocks, the mass exodus out of growth stocks. What happened? The QQQs, they retrace 12%. You go through a correction there, a smaller term correction there. What happens? New all-time highs. We're sitting at all-time highs again. So every correction has immediately resulted in a new all-time high. So there are different generations of investors. So I'm coming from an era where when markets corrected, they were that way for like a year or 2 years. You never made an all-time high. I traded an entire decade and the market's never made an all-time high. You have about 27 all-time highs already on the Dow, and we're only cresting May here. So this is a completely different element. So as the newer traders come in, I'm not saying this is the right way, the wrong way, judging or anything, that don't get me wrong. But as newer traders come in, this is the market they remember. For the older timers out there, because there's some of you out there as well, it's our job to adapt and adjust to the way the new market is working, because this is the new normal. This is the reality of the situation, which is something I teach thoroughly, shameless plug for the course, thoroughly in the course. It's the reality of the situation. The charts tell us what it is that we need to know about an asset, and it's reflected in the price of the chart. And right now, you can't make a bearish case when you get an opportunity for the bear camp to sell off this asset, and then it just kind of spits in the face and makes another high, and now it's breaking out towards the end of the day. Now, we can go debate news. Oh, this is what happens. This is what's said. But in the end, that doesn't matter. So if we talk about a couple of stocks, I tell you what, I really want to look at this Qualcomm. I'm interested in this one because I think this daily chart looks really good for a swing trade. But I wanted to wait till after earnings. So I'm not going to do this here anytime soon. It's going to be a few days from now. I want to see this thing hold steady around its earnings. I want to see it hold up inside of this gap right here. Let me open up the daily chart just a little bit higher. I want to see it hold into this gap. It can pull back a little bit, but I don't want it inside of this range. If it can just kind of build here for the next few days and start to curl up, I like this one. And the reason I like it, it's one of the few other techs that have really made a high. So if we look at recent highs prior to the correction in tech, this is 167. This thing was just a few months ago. So there's a lot of void to fill up here in this stock. It's just not ready right now. So I like this one here. I still like this Tiger, T-I-G-R. I mentioned this one here. I'm liking the way this thing is setting up. Let me clean up my mess here. It's doing a really good job here. It's nice and grind up here. I think it's just one step away from catching here into the 30s and then possibly moving up into the 38s. So on that note, you've got a lot of great names. I mean, this Facebook is doing well, but I think it's a little too high. Spot here is a stock I'm also interested. It didn't do so well after earnings, but it's also a former runner, 387, the recent highs. You're getting very close to a support area. If we can get down here and hold, I like this one too, for at least a run back to 300 and who knows, maybe 400. But let's look at this market. It's not a trap just yet. I mean, they obviously caught short-term traders or aggressive traders, and this is why patience always pays. There's a big difference between trading with your intellect and then trading on emotion, right? If you're trading emotions, this is what happens in the morning and why most traders shouldn't trade during morning hours, because you dive into all of this stuff. So think about the market plays games on it. It is rigged to screw with your mentality. This is the challenges we face as traders, because you think about what happened and that the herd is always wrong, and that's you get a good response to the Fed meeting. Bullish. It's going to continue. This bullishness is going to continue. You immediately follow that up with big name techs, Facebook, Apple, great earnings. NASDAQ shoots up after hours. Bullish. This rally's never going to end. So you're sort of hypnotized from the Fed speech to the open. And as soon as that bell rings, everybody's just throwing money at everything. And then the next thing you know, they get barbecued here, right? They get a big old bag of pepper jack cheese smashed right to their face. They get cheesed. You don't want to get cheesed. Hashtag cheesed. So you don't want to do that. And they get these poor entry prices, and then you get these big sell-offs. They panic sell. Then later on, the indice runs all the way back up and the stocks come back off and they hate themselves and feel stupid. I know. I've been there before. Anyway, guys, I want to thank you for watching this video. Market's still bullish right now until we can get some consistency to the downside. For trades, I like Qualcomm. I like Lulu. I like Vuzi still. I like, who else was I talking about? I still like Pavem. Yes, the Pavem crowd out there. I still like the Pavem. I still like these trades. So keep your eye on them. I want you to trade well. If you need help, you can also join our private community. The links are down there in the description box. Take care. Thanks for watching this video. See you soon.